Well, happy Monday. It is November 6th. Want to bring you the latest data here in the Austin metro area. We're going to start with interest rates, some big changes over the last week. We're going to switch then into some national data that just came out this past week, and then we'll dive into some up-to-the-minute local stats to bring that to you. So looking at interest rates, right now the 30-year fixed is 7.38%. 15s actually, and the 30-year FHA have now dropped down below 7%. That's the first time we've seen that in a while. So what happened from 8% to under 7.5%? Mortgage rates had a near record week. So there was a lot of data that came out last week, about 3 different points. You can see on this chart kind of this steady rise we had the past 2 or 3 months. We touched 8% just a few weeks ago. And then you can see this big drop off last week, which dropped, 60, 70 basis points from that October 19th high around 8%. Basically, the Federal Reserve didn't raise their rate. So that was point number one, kind of gave a tone that they might, they're kind of interpreting they might be done kind of raising rates. That was number one. Number two, the Treasury, which issues bonds, said that they're going to slow down how many of the long yield bonds, the 10-year and the 30-year fixed. They're not putting as many of those into the market. So that created a little bit of rush to buy those instruments, which lowers the yield. And then we had some economic data that showed the job market is slowing down as well. So that's just kind of relieving the pressure on the demand of that. So we saw interest rates come down kind of almost half a percentage point in just a few days. And so will that last? Who knows? You can look back at this chart and see a big drop and then a rise. You can see a big drop after Silicon Valley. Well, that was actually in May. You can see kind of sometimes they drop, but then they'll go back to a steady climb. We're going to have to wait and see. But it is good news if you're buying right now or trying to lock in an interest rate right now, you got a little relief from last week. Let's look at some national data. So Johns Burns Research and Consulting is a very well-known consulting firm. They look at both the residential market and the commercial markets, and they put out a lot of great data. I follow them. So this is residential housing markets, and this is looking at temperature. So a slow market or declining market is going to be yellow, orange, or red. And an appreciating market right now is going to be green or dark green. So if we look at Texas, Fort Worth, Dallas, Houston are kind of in the normal category. Austin is cooling. They're considered in the slow, and San Antonio is super slow. Denver, Salt Lake, Minneapolis, Baltimore, those are kind of your slowing markets. And then San Francisco is considered extremely slow. So that's kind of a graphical look at that. If we look at that kind of in a different way, this is looking from October of last year through different month segments to October of now. If we come down to San Francisco, they've been super slow the whole time. San Antonio has been slowing. So we're seeing the amount of inventory climb in San Antonio. Here's Austin. We were super slow last October. We've kind of gone back to being slow, but still a slow market, but has been kind of slow and steady all year. Phoenix is in there in the middle. You got a lot of your major metros. Dallas is still considered, it's slowing a little bit. It slid back into the neutral category. Houston is considered in the normal range. So this again, John Burns Real Estate Consulting. This is looking through October of last month. This one's a little bit interesting. Change in the number of resale or the percent of resale listings. So in other words, if you were very low on inventory at this time last year, and now you've been increasing in inventory, you're going to be in the red. Whereas if you are now still at or below where you were this time last year, you're going to be in the green. So Seattle is down 47% in the number of homes for sale right now than they had this time last year. Vegas, San Diego, or Orange County, Phoenix. So they're still really low in inventory compared to this time last year. At the top, San Antonio, Houston, Austin, Dallas, followed by Nashville and Miami. So those are your markets that right now have a little more inventory than this time last year. San Antonio, 30%. Austin's about 9% more inventory than this time last year. So it's not how much total inventory do you have. That's a different equation, but it's how much more than last year. I think what's hidden in this data, and I have nothing to back this up other than intuition, but when you have prices go up and then you have interest rates go up, that's affecting all these markets. But what's different about the Texas markets than these other markets is 2 more factors. we had property taxes go way up because we get reassessed every year. And I would argue many of the counties, including Travis County, where Austin is, overshot. So now many of the properties are appraised higher than what they will even sell for in the market. But the problem is when you go to buy that property, the buyer has to factor that into their mortgage equation. So now you have higher price, higher interest rate, higher property taxes. And of course, now in 2023, we're also seeing insurance go up as well, sometimes 20, 30, 40, 50% on some of these properties because of the insurance market. So that's like a triple whammy. It's not just interest rates, it's also property tax and insurance. And I think that's acutely affecting Texas and to a lesser extent, Florida in terms of insurance, and California too. But that's a look at kind of nationally. And my gut tells me that what's not being said here is that it's harder to buy in Texas right now because it's not just the rate and the price. It's also the higher insurance and taxes. And that's making that payment really kind of exponentially jump. All right, we want to now shift over to local data. This is looking in real time at the original price versus the sold price. So the list prices are in green, and you can see we kind of sellers were asking the most back in March, and it's just kind of gradually shifted down. It had a little bump in September, but it's shifting down. Ignore this final bar. This is November. We're only on November 6th. This data is really skewed to much smaller data points in terms of the houses that have trended in this time period. But I would look at the longer term trend that we're seeing, the list prices just gradually coming down, down, down. The sold prices are in blue. We kind of peaked out in June at 475,000. That was sold median price for the metro. We're now sitting about 435,000. Our low for this year was 429,945. So we're about 5,000 within the low of this year. I expect by the time we finish November and December, I think at least we'll be back to February. We could be a little lower than February. So, the median price is just trickling down. Not hard, but it's just kind of softening. And we're seeing that in the market. I'm going to shift to these data points here. This is going to be historic sales price trend, and I've shown this to you before. But basically, if we go all the way back to 2013, our median price was 200,000. We doubled by the time we got to the beginning of the pandemic. We more than doubled it. We went up, 4 or 5, almost doubled again by the time we got to May of 2022. We had the huge fall last year, but we're still way over the beginning of the pandemic. Right now, you can see this year is this little speed bump right here. It kind of mirrors a little closer to what we saw in pre-pandemic years. Obviously, it's been a slower market to try to get your home sold. There's definitely some more credits and things that are baked into that as well. But in terms of just the pace, we're seeing the little rise and fall every year, that little bell curve, just not changing as much. And so I think that's a sign that the market's trying to figure out how to stabilize. Finally, this is number of active versus sold listings. So this is kind of how you figure out what is the market temperature going to feel like if you're trying to buy, sell, or invest right now. So the active listings are green, and we peaked out on those in September. That was about 11,300. We're down to about 10,900. So it hasn't really fallen as much as we're used to in the fall. We're seeing it's just taking longer. We're seeing houses just kind of sit on the market. The number of sold units peaked in May. That was about just under 3,500 units. Last month, we closed only less than 2,300 sales. So in a market where you have almost 11,000 listings, 2,300 sales, that tells you we're between 4 and 5 months of inventory. It's just going to be very slow. If you're a seller, that means on average, the average property may take 4 or 5 months to get a buyer. If it's priced better, it should sell faster. And if it's not priced well, it may never sell because you just sit on the market too long. So that's kind of where the market is right now. And again, this is a look at November. In terms of active listings, we're still kind of, trending pretty closely. I'm expecting this is going to come down as we go through November and into December. I am starting to see, as I niche down and start looking into neighborhoods and zip codes, I am seeing more withdrawn listings. So a withdrawn listing is the seller saying, hey, I'm not waiting for my listing agreement with my agent to expire. I'm just going to call it now. I'm taking it off the market. We'll wait till the spring or I'll rent it out. And so we are seeing more withdrawals come into the market. That's pretty typical for the fourth quarter because sellers feel like, hey, it's going to slow down for the holidays. I don't want to sit through that. I'm going to take my house off the market. However, that's just more inventory that needs to come back to the market next year should they choose to sell. So if you're a seller right now, you want to be watching this data closely. Definitely contact me. I can pull up real data in real time for your area, your zip code, your neighborhood to kind of see what we're competing against because the buyer activity is going to slow down. It's showing us that in the sold data. And of course, interest rates have played a big part of that as well. For most of this time period, not only seasonally do we normally slow down, but interest rates were going up. It just created more downward pressure on those buyers. Maybe a little relief in November and December. If we see that stay kind of consistent in mortgage rates, that would be beneficial. That would be nice. But it's hard to bank on that right now. The interest rates have just been too volatile. If you are a buyer right now, just know you're probably not going to have a lot of competition. You are also going to be watching the inventory slowly shrink. So just know that not every, there won't be as much to choose from as maybe you saw over the summer or early in the fall. Typically, we see that shrink through January and then start to crest, and the inventory will start to pick up again as we get into February. Anyways, I hope this is really helpful information. I look at this every week and share it with you on my YouTube channel at Ryan Kelly Group. Make sure to go there and subscribe if you want to make sure you're getting these videos each and every week. But otherwise, we are now 3 weeks from Thanksgiving. Man, that came fast. And so we're going to be watching this every week. If you know anybody looking to buy, sell, or invest in real estate, would love the opportunity to talk with them. Otherwise, enjoy the lovely fall weather, and we will catch you up next week. Thanks.